Next up, here are 3 data points that I will be monitoring closely in 2024. Number 1 is the stress test interest rates. What are the stress test interest rates for those of you who are joining us only on this part? The stress test interest rates are the interest rates that the banks utilize to evaluate your TDSR. So our MAS has stipulated 4%, the current bank stress test interest rates hover at 4.5, 4.7 or 4.8% depending on which banks you go and depending on what kind of properties you buy. And I have consolidated a table to illustrate to you the impact of a slight change in these stress test interest rates. I'm going to pull it up again for the benefit of those of you who are just joining us on this part. Assuming you have a combined household income of $10,000, right? If the banks were to adjust their stress test interest rates from 4.7% down to 4%, right, you're going to have a bump of $130,000 in your budget. You can take additional loan and then that's the increase in budget that you will have. If you have a combined household income of about $22,000, you're going to have a bump of budget of $270,000. So as I mentioned earlier on in the video, this is the biggest and most important data point that I'm monitoring, because should this stress test interest rates drop, everyone across the board is going to see a bump in their budget, and that difference between the seller's asking and the buyer's budget, right? Should the buyer's budget get bumped up a little bit, and as that gap narrows, one of the buyers, right, some of the buyers were bound to just bite the bullet and make that jump up, and once a buyer will create a seller will become a buyer, and so on and so forth, and that triggers the start of the new upturn in the cycle. And that brings me nicely to the second point, which is HDB Resale Price Index. While this is the best data point that I can monitor, there seems to be a small disparity between the Resale Price Index and what is happening on the ground, to be precise, right? Especially now that HDB is starting to split up the supply in terms of 5-year MOP and 10-year MOP units. So, you know, they probably and they might have to make some tweaks in terms of how they calculate this resale price index, because that may not have a direct impact or direct reflection and accurate reflection of what happens. So to give you an example, in this year's market, if you were to go to somewhere a little more central, prices are still on the uptrend, pretty stable, or on the uptrend. But if you go to somewhere in the more outskirts area with supply being a bit higher, especially the MOP supplies being a bit higher, you do notice prices either maintaining at a level or dropping off slightly. For those of you, while this is the best indicator for us to take a look at, it kind of really depends on which area you are at. But now, why do I still take a look at it if it's not, you know, the most reflective of them all? I want to see if the price index really will take a dip. Okay, if it doesn't take a dip, then I think in terms of the upgraded demand, so to speak, especially for the first half of 2024, will probably mirror quite closely to what we see in 2023. But once this price index takes a dip, and let's say takes a dip over 2 consecutive quarters, then that may bring us back to the days of seen here in 2018, 2019, where private hits up and HDB prices hit down, and that will sort of create a reverse FOMO phenomenon whereby HDB owners then start to rush to let go of their HDB because they feel their HDB prices are coming down. Right now, they don't have that feeling because prices have been somewhat moving in the same direction, right? So once, if it were to start to dip off and private continue to go up, then that will create a little bit of FOMO effect for the HDB upgraders. Then that would sort of perpetuate uptick in the price movements over in the private sector. Next up, one of the third interesting data points, it's the new CCR TOP Supply Performance, right? Case in point, our friends at Leiden Green, Copa, for example, these are the first batch of the new launches in the CCR that came up 2 to 3 years back. They're finally hitting their TOP, and right now it's where, right, it's the true litmus test, the value proposition on such units, okay? Because the sort of the narrative during their launch at that point in time is because everything else, the prices have gone up, CCR has been somewhat stagnant and moving sideways, and so that this gap is getting wider and wider, and eventually people are going to realize it and then jump into the CCR market. I still very much think that there is still value propositions in the CCR market, but then again, like I said, the CCR market is not created equally. The supply into the CCR market is a lot more diverse as opposed to the supply in the OCR and the RCR, so you have to pick correctly. The reason why I'm monitoring that data point closely, especially the profitability of those units, is because this is the first time we're gonna see, while one bedder's 300-400 square feet we've seen before, right? Two bedders at 700 square feet, especially in slightly larger size developments like Leiden and Copper. We have 900 square feet, 3 bedders, 1000 square feet, 3 bedders. This is one of the first few times you're seeing this kind of supply come into the CCR market. Supply that have been very well received and performed very well in our OCR and RCR market. Now, would that translate over into the CCR? Now, that's something that I'm very, very interested to find out. Okay, and next up, right, since we are on this table, I'm going to share with you a little bit of the data, and we break it down into this chart, right? You can notice post 2015, the OCR outperformed everyone else. You can see over here it rose up pretty high. But in the last couple of years, it was the RCR that outperformed. And perhaps let me share with you a little bit of the change in data that can sort of correlate to this change in price performances for the areas. Notice here, this is a table of the private residential supply by expected year of completion ranging from 2016 to 2020. Notice over here very little numbers in the CCR, primarily in the OCR, okay, 60%. And you can draw the correlation once a lot of new launches come up in a particular area like the OCR, then they tend to outperform in this period, tend to outperform the rest. Now there's a change. Right, we see over here, the TOP from 2023 over to 2027, the chunk of supply is then going to come in, still in the OCR, but that split now has shifted quite a fair bit over to the RCR and also the CCR, with RCR picking up a lot of that numbers. And this, I feel, is one of the key reasons why the OCR has outperformed the OCR, with the property price index primarily pushed and led by new launches. Okay, so now with more and more CCR launches coming its way and TOPing especially, hopefully we may see a slight change up in this direction. It's sort of going to bring a lot of attention and a lot of self-fulfilling kind of conviction into the CCR market.